markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey crew, welcome to another episode of Chat with Traders, number 211. Accompanying me from Fort Lauderdale, Florida, is 7 Points equities trader Stan Gluzman, who you may recall from episode 171, which we recorded almost exactly 2 years ago. If you haven't heard that episode or you happen to miss it for some reason, it's definitely worth a listen when you get a chance. So given this is Stan's second appearance on the show, we start with the main areas that he's improved upon in recent years. We then proceed to chat about the opportunity set of 2020, looking back on it, Stan's systematic model for position sizing and scaling risk, his foray into swing trading, and we then have some great discussion about intraday trading too. So things like recycling shares and timing, entries, exits, etc., flipping long to short, intuition, and Stan gives his views on the relevance of tape reading today. Just before we get started, I will quickly mention two things. So this was recorded before the whole GME saga. Just thought I should point that out, although I'm not sure if it makes any difference. And you'll hear we reference how Stan traded Tesla one day in January. To see his executions and exactly what we're talking about here, peep the show notes at chatwithtraders.com/211. And now, folks, I present to you episode 211 with the talented Stan Gluzman. It's been a couple years since we last spoke, and if you think back to how you've performed over that time, those past couple years, where have you seen your greatest improvements?
It's just minor improvements pretty much every day. It's just kind of staying open-minded and looking for new setups. So I would probably say definitely two biggest areas of setups and also like the mental game, where the setups I learned, kind of increasing holding period where, I would short a stock, and instead of covering in the next, 10 minutes, I can cover in the next 3 hours or so. So it's kind of a setup is on a different time frame. So I don't really look at the 1 minute chart anymore. I do to like time the entry, but I focus on like 5 minute chart is pretty much the shortest time frame, and then I look at a 1 hour chart for like the big picture idea. So probably the biggest improvement is just patience for the trade to actually play out. So that allows me to kind of scale into the trade with a bigger picture in mind and capture a bigger move on bigger size. So, and that also falls into like the mental aspect of it, where I know that I have an edge that's a strong edge, and I have a lot more conviction. And if there's like a bounce in the stock that I'm in, I'm not too worried. I'm still, it's still part of the plan. Whereas a few years ago, I maybe would have been shaken out pretty easily. So that's a few improvements there. I think just minor tweaks here and there, and just talking to a lot of, I don't know a lot of great traders. I know a handful of really great traders, and just kind of bouncing ideas with them and then seeing what their process is like and implementing some of their ideas into my process. I think that's been the biggest improvement, and it shows in the results for sure.
Okay, I'm going to make a note here because I'd like to ask you a bit more about some of those setups, and I think we'll also get more into the mental game aspect of it too.
Yeah.
But if we just look back at 2020, I think you clearly had a good year. Where were, or rather, what presented the best opportunities for you then?
So 2020 started pretty good, just kind of taking my regular momentum setups. And then obviously the market started to crash in February, March. Everything was just dropping. And we were trading, I think I was trading oil quite a bit because it was very liquid, and the quotes were very thick in the oil names, and I'm pretty familiar with the oil stocks. But I think for the most part, uh, two different areas. The first one, when the market was moving, it was kind of a sector play. It was a market play. So when I'm watching high beta names, and I put, say, 15 of them on my screen, and I'm trading, let's say, 5 of them, the most liquid ones. When I'm trading a basket, it's much easier to get a feel for the market because, I know which ones are the stronger ones, which ones are the weaker ones. And so when everything is kind of moving in the same direction because the market is dropping, I can kind of get a feel for, the first 3 stocks dropped, and the other 9 are going to probably drop as well. So when the market was moving like that, it was pretty easy to trade, a basket. And I think in April and so on, later that year, people started to get stimulus checks in the United States. And I mean, it just felt like all the stimulus checks went straight to the trading accounts because people were buying penny stocks. Everybody got $1,200, I think up to $1,200, but people were buying the trashiest stocks. And there was record number of trading accounts opened up. Just all records were broken, in that regard. And things were just going vertical. All the penny stocks were going vertical. Like people were just buying everything. And the craziest thing, man, I'll tell you this: I've never seen anything like this. People on Twitter. So I'm part of this. I would say I'm part of this like FinTwit. It's called like a trading Twitter community where everybody kind of knows everybody. It's a pretty small community, but a lot of new people started to appear, and they were following guys that are just pumping. And these guys, I mean, those guys would have like 100,000 followers, and they don't, like, if you read their tweets, they don't really know what they're talking about. But they're just pumping, and everybody is following them. Everybody is just buying what these guys are recommending, and those guys are like sort of talking about risk management, but they don't really know what they're talking about. They've been trading for like 3-4 months themselves, and everybody's following them. So that was the craziest thing. So all these stocks that are going from $1 to $6, $7, $8, they would crash in the next couple of days back to like $2, $3, $4, and then bounce and then crash again. And everybody would buy, and everybody is underwater. I think most of those people don't trade anymore. I think they all pretty much lost money. But I think right now there's a second round of stimulus checks, so things are ripping up again. The biggest area where I made the money was trading small caps, both long and short, but mostly on the short side where things get really overextended. And that's been my bread and butter for a while. But this time around, there was just a lot more volatility and a lot more liquidity. And the biggest difference was the reward for the risk was so much greater. So I didn't really take different trades as before. I just had a longer time frame, and also the reward was just much greater. Where before it was like 2, 3, 4 to 1 was a good trade. Now it was like 8, 9, 10, something like that to 1. So that's why a lot of people had, a really good year in 2020, in my opinion.
If you think back to March when the market was going over the edge of a cliff, I don't recall what year it was when you started trading, but I'm pretty sure you wouldn't have seen anything like that in the time you've been trading. What was that like for you? And do you feel as though you kind of maximized the opportunities at hand, having not gone through something like that before?
Yeah, I think I did pretty well. I mean, pretty much every week was a record week for me, and we traded a lot of shares. Yeah, like you said, I've never seen anything like this. A lot of things happened in 2020 that I've never seen before. In trading and outside of trading, it was just a bizarre year. I think I capitalized pretty well given my experience. I think 2014 I started, or 2015 I started trading full time. So given my experience, I think I capitalized pretty well. But I think now I'm prepared to absolutely destroy it if anything like that ever happens again. But it just felt like the end of the world, when the market would halt like twice or three times a week or something like that. A few weeks back to back, it's down 7% on the day. Everything halts for 15 minutes at like 9:45 or something like that. It was just cool to trade through a period like that. It sucked that, a lot of people were losing a lot of money. But obviously, if people held, it all came back within a few months.
It certainly did.
Yeah.
If you were to go through something like this again, let's say, touch wood, it doesn't happen for the greater sake, but, how would you approach it differently, if at all?
So right now, like I said, I have a much longer time frame in my trades, so I would be holding a lot more overnight. So I was short quite a bit. Obviously, everything was dropping, so I wasn't trying to buy anything. So I was short quite a bit, but I never really held overnight, and a lot of moves happened overnight. And also in terms of sizing, I've been able to size up. In the past, in 2020, I've been able to size up, and then I think if anything like this happens again, I would be trading pretty crazy size and holding it overnight. So it would be a different. It would be the P&L. The P&L would look a little different. But also, when everything bottomed out, I didn't really know how to buy it properly. But in the last, couple of months, I've been working on the long setups, like swing long, and I've been doing okay. And I think I would be absolutely buying as it's reversing. I would be buying and holding.
Yeah, with the overnight plays, I mean, what's your thinking there? Obviously, to capitalize on big gaps that happen between the close and the next open, but what would give you the confidence to hold something overnight?
If an entire sector, for example, if I was trading oil sector, and if the entire sector is weak all day, it's not really making higher lows. It's just downtrending on every single time frame. If I'm looking at a 1 hour chart and it's below all the moving averages and there's really no higher low, it's just lower highs and it's closing weak. I like to trim and then hold a piece overnight and see what happens, maybe a quarter of the position or whatnot. And when everything is gapping down, and the money is in the gap down, now you can probably size up and actually hold, more than a quarter of the position for the gap down. So it's just kind of recognizing the pattern and just, putting the money where the pattern is at.
Yeah. Well, I guess it's nice for you and all of us who are trading through that period to have sort of gone through something like that now can maybe be a little bit more prepared for, if we see something similar again in the future. Mm-hmm. Let's talk about the sizing, because I actually sort of skimmed back through our last podcast yesterday before doing this, just doing a little bit of prep. And there was one thing you said in it which was quite interesting. You said you should always be working on some sort of project. For you in 2018, that project was sizing up. And you said it hurt your consistency a little bit because you were often trying to, bag home runs each time. So 2019, the goal was to find a balance between sizing and consistency. So I'd like to ask you, how was your journey of increasing size? How did that develop in 2020?
Yeah. So I'll tell you, I can't say I found a balance, but I'm definitely on the right track to find a good balance. And I've developed a system, like you said, traders should be working on the project. And, I had a few projects. The main idea that I, developed and deployed in 2020 was actually two models working together is max. How do you know how much money you should be risking on the day? So like max, like lockout, on the day, as well as the risk per trade. So I believe that a trader should earn the right to size up. And how do you earn the right to size up? Usually it's a pretty subjective kind of a number. What's your ARP per trade, or what's your max loss on the day? It's a pretty subjective number. It's kind of like what, in the prop world, at least, it's kind of what your risk manager feels like you can handle, or what you feel like you can handle, and you discuss it with the risk manager and you come up with a number. But then you kind of ask for, can I go bigger, and then you go back and forth constantly. So I've developed a system where it's based off of my performance. So I'll take a 22 day, which is 20 or 22 days is how many trading days are in a month. So I'll take an average green day, multiply it by 2, and that's how much I'm going to risk on any given day. So the idea here is that I'm never going to lose too much. I'm never going to blow up, because if I basically get locked out, if I basically blow up, get locked out, it's just 2 green days, and my risk per trade is a fraction of that number. So let's say my risk per trade is like 1/8 or 1/6 of my daily lockout. So that gives me like 6, 7, 8 trades per day to maximize my average green day, or my green day. So if I'm taking good trades, my average green day should increase, and therefore my max lockout should also increase, and therefore my risk per trade also increases. You know what I'm saying? So it's like a domino effect, and now it's like a game. How big can I get? It's like, but I can't just pile in just because I woke up and felt like I want to pile in. I'm doing it very slowly, so that 22 average green day slowly rises up. And I was surprised by how fast it can actually move. If I'm trading with a 5, 6, 7 to 1 risk reward, my average green day goes up real fast. And my lockout goes up really fast, man. And when I do get locked out, I look at the number, and it's mind blowing, because it's such a huge number. I couldn't even make that in a couple of months, a few years ago, and now I'm like blowing through that in a few hours in the morning. And but I can sleep at night, because I know that I can make it back in 2 days, so, or 1 day. So actually, I don't use a 22 average green day. I use median green day for those who want to try and implement. It takes out all the outlier green days. But the idea is I don't want to lose too much, and I can sleep at night when I do get locked out, because I have confidence in my trading. If I do get locked out, it's just 2 days, and my risk per trade is directly proportional to how I'm trading. So that, kind of took my sizing to the next level, and it's responsible. It's all about sizing up responsibly.
Yeah, it's kind of a nice way to do it, I think, because it's like because you've got like a rolling average of your last 22 days. Mm-hmm. I mean, it's not like it's a big jump, like you're not clipping up massively from day to day, or, each time. It's like it's gradual increases, but as you said, it sort of ramps up pretty quickly. And when you look back, maybe over the past few months, you've actually come a long way in that time, but you sort of don't really notice it from day to day too much.
Yeah, exactly. And it worked out perfectly in 2020. It just worked out perfectly, because I was trading a little bit bigger, every other day. I was trading just a little bit bigger. If you're trading, 1,000 shares today and then 20,000 tomorrow, you're going to freak out and lose money on the 20,000 share position. And then you're going to go back to 1,000 shares, and now you have no confidence. So it's like, digging a hole, but you got to size up responsibly. And I found this way, this worked out real nice for me. And, if anybody wants to implement that, it's a good way to size up responsibly.
Yeah, it's a pretty simple formula. How often are you hitting your lockout limit for the day?
Not too often, maybe like twice a month or so, but I don't trade until I get locked out. Ideally, if I'm down on a day, if it's just like one average green day or half average green days, as long as I've exhausted all the opportunity, I won't be trading, but maybe twice a month.
Okay. You said your max per trade risk is a fraction of your max lockout risk. I think you said something like 1/8 or maybe 1/6. Does that just sort of vary from trade to trade a little bit, or is that a hard and fast rule also?
It's a little more discretionary, but I don't keep it at like either half or I won't risk the entire thing on one trade or anything like that. It's anywhere between 6 and 8, depending on how juicy I feel the setup is. At the end of the day, I'm a fully discretionary trader. I try to be more systematic, but I'm a very emotional person, and then if I see a really good setup and I try to size up a little bit, I'll use a little bit more size, but I'll never go, bigger than like, 1/4 or something like that. Yeah, just trying to keep it consistent and not go outside of those boundaries too much.
Yeah. And even though, like we just spoke about, it's kind of been a gradual increase of risk, you were like, when I look at my lockout limit today and I, see that figure, 2 years ago, I couldn't even make that in a month sort of thing. Even though it is sort of a gradual increase over the years, has that also come with some psychological difficulties still? Like you said, you're an emotional person and all that, as we all are to a certain extent. Have there been any, psychological barriers you've had to overcome to, size up appropriately?
Before I implemented that, 2 median green days rule, I had more psychological issues after I would get locked out because I would get really depressed. And it was tough to deal with. I would like want to just curl up in a ball and not do anything. I didn't want to work out that day or anything like that. But now, I've hit a new record red day so many times now that as long as it's not more than a couple of green days, I don't really care anymore. Do you know what I mean?
Yeah.
Like I have a lot more conviction. I have a lot more confidence in my trading nowadays so that I don't get depressed anymore. And that happened to me. I think I noticed it like a few months ago. I hit like a crazy number, crazy red day. And somebody messaged me, one of the mics, either Manjiri or Katz messaged me and like, you good? I'm like, I don't give a shit. Like I feel nothing, of course it sucks to take a big red day, but I think because I know that it's just like I can make it back in just a couple of days, like I feel very comfortable. So it used to be much worse. Now it's gotten better. Maybe it's just because, just with experience, I've gone through it so many times through that sort of a thing where I just lose so much money that I've always made the money back in a couple of days. So doesn't feel too bad anymore.
If you think back to your best trades, or your best trade, if you want to talk about a single trade of the past year, what lessons can be learned from this?
Of the best trades,
I don't know if there's one that stands out to you.
I can't really think of any like single trade, really good trade. I think I've made some mistakes. I've had one trade where I bought Tesla. I bought the Tesla breakout and I sold it too early because I took a big loss on a different stock because I oversized. I think just following the plan. Following the plan is just the most important thing. And once I start to, get too overly confident and start doing things, I feel like I know what I'm doing and I start doing random shit, things start to fall out of place. So I think the biggest thing for me is to just follow the plan, not risk too much. There was one trade where I lost basically in like 3 or 4 average green days in just one trade, and I was like, oh my god, that's a crazy red day. And I just bought Tesla. I just bought Tesla in my swing account like a few days ago, and it's going vertical. And I'm like, I have to basically close this trade just so that I don't feel like crap about this massive loss that I just took. So I just closed Tesla, and now I'm basically flat on the day. But then Tesla just kept going vertical. So that was pretty much the biggest error that I made in 2020. I know you asked about the best trade, but I can't really think about the best trade. I can only think about the worst trade.
So what went wrong on this other trade that you ended up losing? Was it the equivalent of 3 green days?
Yeah, it was just oversizing. Yeah, just getting greedy and thinking I got this where I don't, and just going way too big. And then in like a couple of candles, I'm marketing out and I'm top ticking the entire stock, taking it even higher. And it's just a fat loss. And then the stock reversed and went in the direction that I was positioned in without me. And now I'm depressed, and now I'm staring at this huge loss. And now I'm thinking I got to close my swing positions, and just missed out on just an absolute massive opportunity there, all because I didn't follow the sizing plan and I, oversized.
Yeah. Oh, there's a lesson to be had there.
Yeah.
We were talking a little bit before hitting the record button, and you spoke about how you've been, you used to do a lot of short trades. You'd mostly play on the short side. But as of late, more recently, you've been more and more trading the long side. So I'd like to ask you, what are some of the most effective plays or setups you've been trading currently?
Well, it's definitely mid caps and large caps, just buying breakouts. So what I do is I'll scan for stocks that have been strong for the past couple of months, up to like 6 months. And I'll find, tight consolidations where a stock, went up, consolidated for a couple of weeks or a couple of days, couple of weeks, and then starting to break out of a tight pattern, whether it's like sort of a descending or ascending triangle or just a level that is breaking out of. And I'll just buy the breakout. And that's the strategy that's, Jesse Livermore used. So if it's good enough for him, it's good enough for me. And I got to give the credit where it's due. I learned it from a guy. His name is Christian Kulamagi. I think that's how you say his name. He just puts out content for free, and I learned that setup from him. And huge thanks to that guy. I've been implementing it, and it's been working pretty well in this market where everything is just going up. I'm constantly asking my managers to give me more buying power because I'm maxing out the buying power in my swing account. Just buying things every day.
That's a good problem to have.
Yeah.
So these patterns you're looking for, obviously you're an intraday trader, although you have been doing a little bit of swing trading also, and we'll probably get to that. But for your intraday trades, are you looking at these patterns sort of on a daily time frame, but then trading, the specific kind of breakout points or thereabouts on the intraday?
Well, yeah. So I'm buying basically like an opening range. Like if the stock starts to break out, I'll put it on like a 5-minute chart, and I'll wait for a dip, or I'll just buy the breakout on the daily, and I'll see where the low of the day is, and I'll put the stop below the low of the day. So if it's a strong stock that has continuation, it shouldn't break the low of the day. Sometimes it breaks the low and then reclaims and goes higher, and that really sucks. But I don't really trade them on an intraday chart. Like I'll time the entry, as I have alerts basically, and then if the alert goes off, I look at the chart. It's not too extended. I don't want to, because I'm also trying to get a good risk reward, right? In swing trading, the risk reward goes up. Like long swing trading, you can make 20 to 1 risk reward. Like it's not too crazy. Intraday on the short side, especially, you can't really do that. I think the win rate is a little bit higher on the intraday. On the short side, especially, the win rate is a little bit higher. The risk reward is a little bit lower. But swing long, the win rate is way lower. It's like if you can get like 45, 50%, that's really good. I think lately it's been higher than 50%, but overall in my swing account, I think I'm at like 37 or maybe close to 40% win rate. But the risk reward is pretty high. It's like 5, 6 to 1. And I'm still a rookie at this. Lately, it's been a little bit higher, the risk reward. But yeah, I just try to buy the breakout on the daily and then put the stop below the low of the day and then see basically how far it can go and then not take any and then just trail it with moving averages. And yeah, like I said, I mean, Jesse Livermore uses basically the same strategy. And I'm sure a lot of people read the Market Wizards books, and I think most people there, that's what they do. They buy breakouts.
So just to clarify, this pattern which you just spoke about, these are for swing trades. These aren't intraday trades, even though you might be entering during the day.
Yeah, I'm not really trading on the long side intraday unless it's like a small, like tiny scalp where I see a lot of demand coming in and I'll buy it for like a few candles or something like that. I'm trying to kind of stay away from those setups. It's kind of a waste of time at this point where I can put my energy and time into something that is gonna pay me off a lot more. So I don't really do that intraday as much. Maybe I just haven't figured it out on the intraday yet. I like to short intraday and I like to long swing.
Okay, cool. Now, with these breakouts which you're talking about here, I mean, it's a very simplistic sort of strategy, right?
Yeah, it's very simple.
What are the nuances to it? Because I presume a big part of it is probably picking the right stocks. Like it's you're going to have a higher win rate or more success with stocks which are in a hot sector, or are there any nuances like that which give these trades a better chance of success?
Yeah, so for me, I try to buy stocks that aren't dilutive, which are basically small caps. They're pretty much always diluting. Like somebody's always selling their at the market offering or whatever. Somebody's always dumping into these rallies. So my win rate on small caps, on the trashy names, or the stocks that like need money, running out of cash. So on those, the win rate for me it's much lower. It's probably like 10% or even less. So I just completely eliminated those. I'm trading like real companies, or at least I try to. Once in a while, I'll buy a small cap. So that's one. Like I try to stay away from stocks that are potentially dilutive. Also, the hardest thing is to hold through a pullback. So me being a scalper, coming from this background of scalping and trading momentum on a intraday chart, where I don't really like to sit through a bounce. If I'm shorting a stock and it drops, I want to cover and reshort higher. So as a scalper, I don't really like to hold through a pullback too much. If I'll short a stock intraday and it drops, I'll cover a piece, a quarter or half, and then I'll wait for the bounce and I'll reshort the bounce. But in a swing trade, the hardest thing is just to not look at the PNL, not look at the intraday chart, maybe 1 hour chart, and just try to sit through a bounce and let the stock take you out basically, and just trail it with a good stop, with a moving average. And sometimes it'll rip up and it'll come right back down and it just sucks. But most of the time, it'll rip up, it'll come back down a little bit, and then it'll go way higher, And so many times I'll take myself out. I'm like, oh, I just want to lock in the gains. I'll lock in with my like 2R or whatever. I'll lock it in, and then the stock, doubles. It was last week. It was 2 weeks ago. I bought a few stocks. It was the entire like EV sector. I bought FCell, BLNK, Plug, uh, some other stock, and I sold it basically the same day. I mean, they all went up like quite a bit, and then in the next couple of days, they all went parabolic. Uh, I think Plug went up 100% in like 4 days. And like I was long the breakout, but I sold because of that little pullback. It kind of came down a little bit. I got freaked out and I got out, and then in the next 4 days it doubled. So I learned my lesson. It was a very expensive lesson. I'm holding everything now, as much as I can at least. Trimming just a little bit, just trimming a little pieces into strength, and then just trailing the core position with a moving average.
Okay.
So that's the hardest nuance to kind of to grasp. And
I almost can't believe I'm going to ask you this question, but what moving average are you using to trail as a stop?
I think, actually, I don't remember. I think it's a 10 EMA.
Okay.
But I don't remember. I have to double check. It's either a 10 or a 20 EMA on a daily chart. Yeah.
Just that you spoke about when you are trading intraday, if you're short something, and it drops, you're going to cover into that wash. This is something I think you do really well from seeing, your executions, which you occasionally share. A good example of this was how you traded Tesla, I think predominantly on the short side intraday, and then like you flipped to long when there was a, big wash into what happened to be the low of the day. I'm quite interested to know more about how you do this, how you think about, timing these trades intraday, what determines a good price to add, etc. So I know there was just a whole bunch of questions in there, but how do you think about recycling shares on an intraday trade?
It's all about the trend, and it's all about the volume for me. So if the trend is still holding, if the stock drops, bounces, and puts on a lower high, I don't know if it's going to be a higher low or a lower high, but as it's curling down, I'll re-add back. So one important thing that I started doing, I think, was it 2019 or 2020? I don't remember. I started doing it a while ago. Is, for example, if I'm shorting a stock, if I'm adding or re-adding shares to a short position, I don't short on a green candle. I try not to short on the green candle as much as I can. So I'll only short on a red candle, so that I know if the stock bounces, I'm gonna short as it already put on a lower high. So whether it's a 1 minute chart or a 5 minute chart, it's better if it's a 5 minute chart. So a red candle, as preferably even as it's breaking the low of the previous candle. Yeah, so I'll add back on the lower high as long as the trend holds, pretty much. So I'm staying with the trend, lower high, I'm adding lower high, or re-adding, and I'm covering into the washout, lower high, re-adding, covering into the washout. And for me, the main indication of a reversal where I should be going long is a volume exhaustion. So if the stock really extends, and also extension from the mean. So if I'm watching, let's say, VWAP or some sort of a moving average, and the stock really extends from its mean, I know that I should probably be closing or scaling out of my short position completely. So usually I would cover half, but if it's really getting extended on big volume, I'm going to be covering the entire position. And once a massive volume bar comes in, I'll be looking for some upticks. So it's still going to be a red candle. I'll be buying on, but I want to see upticks. I want the stock to start going up, and then I'll start longing it. So only when I see massive volume and extension from the mean is when I'll be looking to buy it. And it's a dangerous setup, and it's not it's for someone who's a little bit more experienced, because if it doesn't stop going down, you can find yourself holding a long position, and just it's kind of off the cliff against you. So the stop has to be pretty tight, hard stop. once once I'm in full size. But yeah, like I said, extension from the mean and huge volume is my main indication for reversal.
Okay, so a few things. When you're re-adding, so say you're short, you've covered some into a wash, pops up a little bit, you're looking for another lower high, as you describe it, to re-add short, but you're kind of waiting for it to like curl over a little bit before you do short it, so you're not kind of shorting that front side pop, if you want to call it that. Okay. When you talk about these volume extensions, points where you will look to cover your entire position and possibly flip to a long, extension from the mean, I mean, how are you determining what is the mean?
The mean, so I'll use a few moving averages. Like I'll use, for example, I think I'm using a 20 SMA on a 5-minute chart. So I'm looking at that one, and as well as VWAP. But for the most part, if the stock just extends, and I've actually coded into my Thinkorswim platform, but I actually don't use the Thinkorswim charts anymore. I used to have this code that shows the percentages in percentages how far it is from the mean, and when it like kind of breaches a certain number, I'll start to think about going long. But now I just like look at it and see if it's like way too far and it's just straight down, like really far from the moving average, then I don't automatically go long. I wait for the volume. I want to see massive volume, and that basically means like people are getting stopped out. Like it's like max pain level where everybody's just getting blown out, and the stock is there's not going to be much more selling after that. After everybody gets blown out. So, and then a little bit of an uptick, and I want to start in and add as it's working.
So, I mean, it's probably fair to say you have a pretty good feel for these sort of things nowadays.
I mean,
which I mean is why you're not so reliant on the things you've coded to look at the actual percentage it is from.
Yeah, because it varies from stock to stock, like percentage wise. But I used to be more systematic, and now I'm a lot more kind of reactive. I don't really think about like what exactly I'm going to do. I was actually telling my girlfriend, I was like, I don't even know what to talk about on this podcast. I just kind of I don't even know what I did today. I just traded today. I have no idea what I did today.
Just on autopilot.
But yeah, so I feel like with experience, the more trades you put on, you kind of start to feel these things. So I don't even know I'm not sure what moving averages I'm even using, but as it's extending from it like really far, there's an opportunity, and that it's just about timing when there is an opportunity.
Yeah. When you are flipping to long at these points, and I'm sure you don't do this every time, but when it seems obvious to you, I mean, is it easy for you to just flip your bias like that? Like I'm sure you've been holding a decent short position throughout a decent chunk, and then all of a sudden you're flipping to long. Is it easy for you to flip your bias like that, or is that something which has also come with more experience?
It's just hard to sit through a pullback when it actually puts on, if you're holding and the volume gets exhausted and it gets extended from the mean and it starts to come back, it's really painful to sit through that low and not cover any, so now I just know that more likely than not, it's probably, if it didn't bottom out on this candle, maybe next candle, pretty rarely it'll, keep dropping. But if I do go long and it bounces just a little bit and starts to curl down again, I'll probably trim or even get out and see if this is kind of an outlier move. But yeah, I wouldn't say it's difficult to flip bias. The only bias is to make money. So if I feel like the stock is going to bounce, then I got to go long.
The only bias is to make money. I like that.
Yeah.
I meant to ask you before, actually, when you were talking about, recycling shares and covering into washes, adding on bounces, etc. From what you described, it sounded a lot like you just look at, the price and the bars, etc. Does tape reading also play into this?
Not as much anymore for me because there's a lot of poker games being played on the tape, and I don't really play poker anymore. There's there's a lot of spoofing, and there's just a lot of games. And if I see a lot of selling, I'll see if the chart kind of confirms. The confirmation's on the chart for me. So I don't really look at the tape as much anymore. And that's pretty crazy because I used to trade without charts. Back in like 2016, we used to scalp without charts completely, just the tape. But I don't really look at it's very fake nowadays. Like sometimes there's an offer that comes in, like a massive offer, and everybody starts to panic and sell, and it just wouldn't go down. The stock wouldn't go down, and it starts to uptick and makes a new high. So, which means that somebody was spoofing to buy the bid, and other times they would show the offer and it would downtick. So, like I don't know. I don't know what their intentions are. Are they going to soak on the bid, show the offer, soak the bid, or is it just somebody trying to sell their position on the offer and the stock downticks? So yeah, I don't really do that anymore.
Okay.
Not as much, at least.
So the same goes presumably for initiating positions, like your entries.
Yeah, for me the chart is everything.
Okay, interesting.
Because the tape translates into the charts. So if you're reading the tape, if you're really into the tape, you can put it on a 1 second chart, and that's basically the tape for you. Because every tick is gonna show on a chart, on a 1 second chart, pretty much. That's kind of how I think about it. The tape translates into the chart, and a lot less headache, reading the chart.
Okay. What about options? Are you doing anything interesting with options nowadays?
Yeah, I started trading options in my personal account. I mean, I still do a little bit of selling spreads and stuff in the 7 points, but for the most part, I don't know where to invest the money, so I'm thinking like the best thing I can do is trade. So I just sell put options, like naked, basically cash covered put options. The strategy is called the wheel, where if there's a stock that I like Apple or Microsoft, something that's like a good stock that shouldn't go down too much. Like I'll sell a put option out of the money and collect premium. But if the option goes in the money and I actually buy the stock, I'll just own the stock and I'll sell calls against it. So the strategy, like I said, is called the wheel. You can kind of read up on that. It's a pretty interesting strategy, more of like a really long-term, like investing. It's an investing strategy, I would say. But it's a cash flow strategy because I sell out of money put options, and most of them expire worthless, especially in this market where everything is really strong. But the main thing is to understand implied volatility and sell when the implied volatility is high. And the implied volatility is high either like before earnings or after like something happens, like after like 3-4 red days. I'll sell after like 3 or 4 red days. I'll sell out of money put option way, like really far from the price, like really out of the money, and get decent premium. And I'm probably never going to get executed. Like it's never going to go in the money. So I'm most likely going to get paid on that trade. But even if I don't, even if the stock, if the option goes in the money, I'll buy the stock that I like Apple, at a really good price, and then sell a call against it. So it's kind of a no-brainer for me. I started trading it, I think, in September last year, and I think I netted like 20% on my portfolio just in a couple of months. So pretty good, pretty decent, I guess, strategy that I found that works for me.
Right. So that's something you obviously need to manage kind of day to day.
Not really.
No?
Just scanning. Yeah, no, just scanning for like high implied volatility and seeing what pops up and then just entering, and that's it. I don't look at the stocks. I don't look at the P&L. I set my target. Like if I'm short, like I aim for 90%. I think it's either 90 or 95. Yeah, it's 90% of the premium. So I'm not going to let it go to zero. I'm going to cover it at 90%. So if I'm shorting at $10, I'm going to cover it at $1, because sometimes I can cover it at $1 in like 6 days instead of waiting for like 35 days. That's when it expires.
Okay. So if someone wants to read up on this, I mean, what was a good resource for you?
For options?
For this particular strategy you're talking about here, I think you called it the wheel.
Yeah, it's called the wheel. I found out later. I mean, I started trading it. I sort of developed it, and then I started trading it, and I started kind of reading up more about it, and it turns out that people use it, and it's got a name. But I think if you just Google it, there's a lot of information on YouTube and on Google. It's pretty popular strategy. So
Gotcha. Okay.
don't really have a source.
Awesome. Last question, and then we'll probably wrap it up. But I just wanted to ask you, like, how's everything going with the Florida office? Because you're sort of heading that up.
Yeah, it's good. We have a lot of applications. Most people are trading remotely, and man, some guys had some really crazy progress in 2020. It's, looking back at when they started and they couldn't even net, $20 on the month. Like now they're absolute monsters, and like really proud of these guys, but we're still hiring. So if anybody's interested, we're Florida office in Fort Lauderdale. Got a small team, really good team, and hopefully we'll be back at the office sooner than later because of COVID, everybody's remote.
Yeah, I bet you missed that.
Yeah, definitely.
How many is in the team now?
I think right now there's 6 of us, 5 or 6 of us. Yeah, it's small office, small team, bouncing ideas and helping each other out. That's how I learned when I started in New York. It was like 30, 40 of us back in 2015. We have a smaller team. We don't really want to expand too much. It's better to have, 6 really good traders than, 100 shitty traders.
Right.
So.
Cool. All right, Stan, If someone wants to find you on Twitter, what is your handle?
It's Chocana Trader, CIOCANA Trader on Twitter.
Okay. And I'll also throw it out there to people listening to this podcast right now. Definitely worth your time to go back and listen to episode 171, which was the first interview which Stan and I did. Well, Stan, awesome catching up with you, man. I'm glad we can do this, and I'm not sure what you were worried about, that we'd have nothing to talk about because an hour's gone by pretty quick.
Yeah.
So thanks a lot for doing this, man. Appreciate it.
Thanks, Aaron. It's my pleasure.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.